Hey, real estate investors and those of you thinking about real estate. Dave Rowan here again, talking about another real estate topic. In this case, it is the real returns that you're getting on your real estate investments. And today we're going to talk about, well, what makes a good real estate deal? And there's really three ways to look at returns. There's cap rate. You've probably heard that term, and that's probably the biggest one that's talked about in real estate. Then there's something called levered return. I'll show you an example of that. And then finally, we'll look at it on a tax adjusted basis. And so look at your tax adjusted levered return. So cap rate, that's short for capitalization rate. Very simple equation. It's basically the net operating income that your property is generating over the current market value. And so looking at a quick example, let's say your net operating income is $75,000. The value of your property is $1 million, and so that would translate to a cap rate of 7.5%, and you can see the math there. Very straightforward. Next, we'll look at levered return. And this is my definition, and it's basically the return you're making when factoring in debt service. And that's, when you take in debt service, that's bad because it's reducing your actual rate of cash coming in the door. But then there's some goodness in the levered return calculation, and it's the fact that you can take out a mortgage. So, when you buy that $1 million property, you're not shipping $1 million out the door, but only your down money and your acquisition costs. So if we look at an example of that, back to our initial property, the $1 million property, we'll look at levered return as free cash flow over the cost to acquire. So same $75,000 in net operating income, but let's say that your mortgage requires mortgage payments of $38,600 a year. That's $36,400 in free cash flow. So that's your actual cash coming in the door. And then total cost to acquire on that $1 million property, let's say it's $400,000, which is your down money, closing costs, maybe some minor repairs. So your levered return is your free cash flow over the money you had to send out the door for the deal. So 36,000 over 400,000 is equal to 9.1%, which is already a big improvement over that initial cap rate. Let's take it one step further and factor in taxes. So rental real estate can be depreciated over 27 and a half years. It's important to note that the value of the building can be depreciation, but not the land that it sits on. But even with that, it's a big savings every year when looked at in the context of your marginal tax rate. So again, let's dig into our example. We've got a rental property that's worth $1 million. Let's assume that the land is valued at $200,000 and leaves a value of $800,000 for the building. Using the 27.5 year IRS depreciation rule, you can take about $29,000 each year in depreciation. And if you, as a household, are in the 32% tax bracket, this yields a tax savings of over $9,000 a year. So if we do some math here, this top part should look familiar to get to that $36,400 in free cash flow. But now let's add back in that $9,300 in annual tax savings. That gives us $45,700 in tax adjusted free cash flow, going back to our total cost to acquire of $400,000. And when we put the free cash flow, tax adjusted free cash flow over that $400,000, now our return pops up to 11.4%, making this a much more exciting deal. So again, we'll move over here. Return comparison, the traditional way to look at it, you're earning 7.5%. You're looking at it in terms of the amount it costs you to service debt, but factoring in you're only putting your total cost to acquire out the door, it goes to 9.1%. And then if you factor in tax effects, you get all the way up to 11.4%. Pretty good deal. So I love looking at this stuff, and there's lots of layers beyond this to both assess deals and make them potentially more attractive. So if you'd love to talk to me about assessing deals or anything else related to real estate, give me a call. And otherwise, if you want to just learn more, go ahead and keep browsing the Learning Center. Thanks.